Now, let's turn our attention to Pimco. The world's biggest bond fund, so it matters where Pimco is putting its money. Let's go over to Michelle McCory and find out what we know so far from New York. Michelle, has Pimco been giving us some hints?
Well, Paul, the bottom line from Pimco is by banks, utilities and energy company debt. I've looked at the latest report by Curtis Newborn, that is a managing director and portfolio over at Pimco, and listed as, quote, compelling purchases are investment-grade bonds from large banks and financial institutions, utilities and some energy companies. Now, yield premiums have now returned to about what they were before the collapse of Lehman Brothers, and the portfolio manager says that while systematic risk has subsided and investors have re-entered the market, economic and business conditions are significantly worse than in the third quarter of last year. And Newborn believes that yield spreads for high-quality investment-grade corporate bonds are still wide relative to historical levels, and that attractive risk-adjusted value still does exist in certain areas of this market. Now, Pimco is somewhat more cautious about high-yield corporate bonds because it does expect defaults there to rise. And Newborn also thinks that there are select opportunities in high yield, such as metals and mining companies, that stand to benefit from the demand from commodities by developing nations. And as for developing nations and emerging markets, well, he thinks that Brazil and China will maintain their development breakout phase, though not at the torrid pace of recent years. Paul?
And we've been hearing from Bill Gross himself as well. What did he have to say?
That's right. Recently, Managing Director Bill Gross cut the total return fund's investment in mortgage bonds to 47% of assets. That is 7% less than a month earlier. And remember, total return is a $169 billion fund, so no small change there. Now, Gross sees that the U.S. economic growth will come in at around 3%. That's versus the 5 to 7% we've been used to in the past 15 years. And he also predicts that the U.S. economy will begin to recover in the second half of 2009. Now, you may want to listen to what he has to say, because the total return fund did return. In fact, it returned 12.3% in the past year, beating 96% of its peers. Paul?
I love it when return funds return. Michelle, thank you.